Imagine waking up tomorrow, you check your phone, the stock market is crashing, every news channel is screaming, experts are panicking, social media is filled with people saying, this is the end, this time is different, sell everything. Your heart starts racing. Should you sell? Should you buy? Or should you do absolutely nothing? Here's the strange part. According to one of the greatest investors in history, moments like these are often when fortunes are made, but almost nobody has the patience to take advantage of them. Today we're diving deep into Warren Buffett's investing philosophy, the hidden psychology behind the stock market, and why most people unknowingly sabotage their own financial future. Stay until the end because the final lesson explains why the richest investors often do the exact opposite of everyone else, and once you understand it, you'll never look at the market the same way again. Let's begin. The stock market looks complicated. Charts move every second. Financial news never stops. Experts constantly argue about whether stocks are going up or down. It feels overwhelming, but here's something fascinating. The stock market has existed through world wars, financial crises, political chaos, pandemics, inflation, recessions, technology revolutions. And despite all of that, over the long term, it has continued to create enormous wealth. Why? Because behind every stock is a real business. Businesses innovate. Businesses hire people. Businesses solve problems. Businesses create products that millions of people buy every day. When you buy a share of a company, you're not just buying a number on a screen. You are buying a tiny piece of that business. That simple idea changes everything. Unfortunately, most investors don't think like business owners. They think like gamblers. They chase excitement. They chase headlines. They chase the newest trend, and that's where everything starts going wrong. Imagine two people. The first person spends every day watching stock prices. Every small movement causes panic. A stock drops 3%. They sell. It goes back up. They buy again. Then it drops once more. The cycle never ends. The second investor does something different. They research companies. They understand the business. They invest with a long-term mindset. Then, they wait months, years, sometimes decades. Which investor do you think usually wins? History gives us a pretty clear answer. One of the biggest misconceptions about investing is believing that successful investors know exactly what the market will do tomorrow. They don't. Nobody consistently predicts short-term market movements. Not billionaires, not television analysts, not social media influencers, not economists. If someone could perfectly predict the stock market every day, they wouldn't need to sell courses. They wouldn't need television interviews. They would quietly become unimaginably wealthy. The truth is, the future is uncertain. Always has been, always will be. That's why the greatest investors focus on probabilities rather than predictions. Instead of asking, what will happen tomorrow? They ask, what is likely to happen over the next 10 or 20 years? That's a completely different question. Now let's talk about fear. Fear is probably the strongest force in investing. When markets fall, people panic. When markets rise, people become greedy. It's amazing how human emotions repeat themselves generation after generation. Think about bubbles throughout history. People become convinced that prices can only go higher. Then, reality arrives. Prices fall. Fear replaces greed. People sell at the worst possible moment. Then eventually, recovery begins. Confidence slowly returns. The cycle repeats again and again and again. Understanding this emotional cycle might be one of the most valuable investing lessons you'll ever learn. Here's another interesting idea. Imagine you owned a bakery. Would you sell your bakery simply because someone offered you a lower price today than yesterday? Probably not. If your bakery still has loyal customers, makes consistent profits, and has a bright future, why would today's offer suddenly change everything? Yet investors do this constantly. A stock price falls. They assume something must be wrong. Sometimes they're right, but many times, nothing important has changed except people's emotions. Price and value are not always the same thing. This distinction is incredibly important. A stock can become more expensive while becoming a worse investment. A stock can become cheaper while becoming a better investment. Smart investing is about understanding the difference. Now let's discuss something almost nobody likes to hear. Patience. Patience sounds boring. Nobody wants boring. Everyone wants fast money, quick profits, overnight success. But history repeatedly shows that extraordinary wealth is often built surprisingly slowly. Small gains, compounded year after year, decade after decade. Compound growth may seem almost invisible at first, then suddenly, it appears unstoppable. That's one reason why time can be more valuable than timing. The earlier someone starts investing wisely, the more opportunity compound growth has to work. Now here's something even more interesting. Information has never been more available. You can read earnings reports instantly, watch interviews, analyze financial statements, study global markets. Yet despite having unlimited information, many investors perform worse than ever. Why? Because information alone isn't enough. Discipline matters more. Anyone can buy a stock. Very few people can stay calm during uncertainty. Discipline separates successful investors from emotional ones. Let's talk about one of the biggest mistakes people make: following the crowd. Humans naturally feel safer doing what everyone else is doing. If everyone is buying, we want to buy. If everyone is selling, we want to sell. But markets often reward independent thinking. That doesn't mean being different just to be different. It means making decisions based on facts instead of emotions. Sometimes the crowd is right. Sometimes the crowd is spectacularly wrong. Learning the difference is incredibly valuable. Another overlooked lesson is simplicity. Many people believe investing must be extremely complicated. They think success requires hundreds of indicators, complex formulas, or secret strategies. But many successful investors keep their process surprisingly simple. Understand the business, pay a reasonable price, think long term, ignore daily noise. Repeat. Simple doesn't mean easy. It means avoiding unnecessary complexity. Now imagine this. You could see every market crash before it happened. Would you become rich? Surprisingly, not necessarily, because knowing something intellectually is very different from acting on it emotionally. It's easy to say you'll buy during a crash. It's much harder when headlines predict disaster. That's why emotional control is often more valuable than intelligence. Let's discuss another fascinating idea. Opportunity rarely feels comfortable. When everyone is excited, opportunities may already be disappearing. When everyone is terrified, opportunities may quietly begin appearing. That's uncomfortable, but investing has never been about comfort. It's about making rational decisions while others become emotional. Finally, let's return to where we started. Imagine another market crash. Headlines are terrifying. Social media is full of fear. Prices are falling. Now ask yourself one question. Has the long-term future of great businesses actually changed? Or have people's emotions simply changed? That single question has helped countless investors think more clearly during uncertain times. No one knows exactly what tomorrow's market will do, but history consistently reminds us that fear and greed come and go. Businesses continue building, innovation continues, economies adapt, and patient investors often benefit over time. The next time markets become chaotic, remember this: the loudest voices aren't always the wisest, the biggest opportunities rarely arrive wrapped in comfort, and the investors who stay calm when everyone else panics often position themselves for the future. If you found this video valuable, hit the like button, subscribe to the channel, and share this video with someone who wants to become a smarter investor. What do you think is the biggest mistake most investors make? Leave your answer in the comments. Thanks for watching. Like and subscribe, it's free.
Like and subscribe, it's free. Don't miss out on more fun.